All right, hey everybody, and we're sorry about the late start. We're going to have a couple more folks joining here in just a moment, but we wanted to put this together to talk a little bit about what's going on in the markets right now, some outlooks from what those of us here on the server are seeing, and just answer any of the questions that folks have, whether that's about anything broader economics level or from a retail investor perspective. And so we're going to do some introductions to get things going. So Modo or Clear, if y'all want to start with your introduction, and then we'll go around from there.
Well, hello everyone. You probably know me from shitposting and swap, but I have a background coming into this from a manufacturing environment and a fair bit of background also coming from an economic development perspective.
And I'm Apogee. I work in the financial industry. I work within financial crimes for a major financial institution, global financial institution. So my perspective on this is a little bit different than somebody on like the trading floor, but I work mostly with retail investors and see some unique perspectives from that, what we're seeing both in the financial crime space and how investors are reacting to the markets.
Can y'all hear me now? I was told I couldn't be heard.
Yes, we can hear you. I can hear you.
Okay, there it goes. Does this work?
That does.
All right. Modo, do you want to introduce yourself?
Modo already introduced himself, or he can reintroduce himself. People couldn't hear him.
No, that's fine.
Then yeah, Astro and Clear, which are one of y'all want to do intros.
Okay, I'll go ahead. So I'm Astrodog. I worked in the financial industry sort of off and on from about 2004 till occasionally here recently as a consultant, mostly with hedge funds and private equity groups doing, things like valuations and that sort of excitement.
And we should have Clear rejoining here in a second to introduce himself. Sorry to everybody for the slow start. We're just brushing off the dust. It's been a while since we've done a talk like this, so we're still trying to get used to running things again. Hopefully once we get all the mic issues and stuff like that worked out, it will be a lot easier for us to roll through this.
I think while we wait on Clear to get his stuff set up, we came up with the idea of doing this talk after sort of having a bunch of different interesting discussions with people about, what the tariffs were doing or what the markets were doing in response to them, and kind of how that all played out just because of how unusual the tariffs were as a set of policy. And, I was talking to someone earlier today and, going through, okay, how do, things like financial institutions and hedge funds and places like that look through the tariffs and figure out like, okay, what do we think will happen with this? Like, how do you treat it? And, you have to go back to the 20s and 30s to find, academic work for how are we going to, what the effects of this might be, or, what a given set of equities or industries or, different market conditions might do in response to it. And I know on like the regulatory side, you see, there's certain things going back 100 years where you can actually chase that down, but generally speaking, none of that stuff has a lot of language around it.
I mean, from my perspective, in the near short term, the most probably analogous thing to what we're about to experience was probably the opening months of COVID when global trade really slowed down and stopped. And I suspect we'll see some of those same supply chain disruptions occur again, especially at the consumer level.
In that way, Fred.
No, go ahead.
I was going to say, one of the things that was really unique about COVID was how, like, all that stuff turned off basically for months, and then things picked up. But, in this case, you have Trump seeming to feel very, very strongly about tariffs, no matter what else comes up.
Yeah, and I mean, and this is something that is much wishy-washiness as there is with Trump and with his administration. He's been, he has been wishy-washy about the implementation of this. We've looked going back over the past couple months with Canada and Mexico, the tariffs there. It was starting with some on again, off again, but which does not help market confidence by any means. And I think that even if the tariffs are lifted in the short term, there's been people speculating about, oh, well, this might only last a couple of weeks or something like that. Even if that was the case, we see these just waves in what Trump and his administration have been doing. And I don't think that the tariffs being removed would help necessarily.
It's the uncertainty that he's willing to do it.
Yeah, but across the board, though, this has been something that he's been talking about consistently. I mean, he's on again, off again about actually implementing the tariffs and pausing them and things like that. But the administration's messaging that we're going to do tariffs, this is our economic tool. This is how we want to raise revenue. That messaging has been very consistent. And I think the markets were surprised in some ways after the tariff announcement. I mean, it was in many ways worse than what markets were expecting. JP Morgan said that there will be blood. Other firms on the street have had similar outlooks, that this is not what was being expected. But nevertheless, I think that there had previously been some uncertainty that these tariffs would ever happen. And the markets are trying to react to that. And
Trump very much, uses extreme messaging and things to try and generally get to a smaller outcome. With this, it's something where he's talked about the way, say, Japan used tariffs in the 80s to, have this massive sort of economic boom. And, I think part of what makes people have a lot of trouble with this is that sane countries don't do this. So no one studied exactly how this kind of thing plays out in a fully developed country.
Yeah, and I mean, Ban Banana Bowl, God, sorry, I'm going to butcher that name. He does have a good point. They haven't been lifted on Mexico and Canada. They've just been really delayed. The date keeps being pushed back on them. They're still on the table. I can still go and find them in HTS if I'm going to go take a look.
All of the harm that generally comes from this still exists, whether they happen or not. It's the uncertainty that they introduce, working with oil and gas companies. It's okay, if we're going to have, say, pipe shipped from Vietnam or wherever we're getting it from. Companies are doing things like, well, let's have the ship with all the pipe just kind of go in circles for a week and then come in a little bit later, and it's all of the costs associated with doing that way.
I imagine the cost of that ship doing circles, burning minimal fuel just to keep the power on there. It's probably cheaper than the 25-50% tariff that they're looking at right now.
Right, exactly. That, that's then a ship that's not doing, whatever else it was going to do. And it's interesting to see this set of policies and the threat of this set of policies where, if you follow like a efficient market hypothesis and all that sort of stuff, you would never do this. And so all of these different companies and financial institutions, all these places, I don't think they appreciated that it was possible to do.
Yeah, I mean, and there's questions about, just rationality. And one of the important things to remember is we haven't, if you look for research on issues like this, there's really not anything recent out there because we haven't seen anything like this in almost a century. That trying to remember if this is like the second or the third highest tariff rate. It's above that of Smoot-Hawley even for some countries. And so just what the economic implications of that are, nobody's had time to really dive into this.
Or even spend time on considering what it is. It predates both, Keyes and the Chicago School even really developing that set of economic thought. So you don't have any, in the financial industry, it means that there's not even like a ideological framework to think about this in. It's just like, well, everything exploded. So there's a chart, I'm going to see if I can find it, that's the implied volatility in gold and crude oil right now are just insane. They just look like fireworks. You don't have any nice curve to them.
I will also say one of the more interesting things here, especially from like an economic development perspective and from a manufacturing perspective, is the uncertainty right now around how long these are going to last makes it very hard to plan for capital expenditure to grow a manufacturing base here. If you weren't already planning on expanding, now's probably not the time, because now your materials you need to build this facility are going to be tariffed. And you're going to see 25, 50% cost increase just on some of your tooling that you're going to probably need.
Yep. But your cost of capital is incredibly high.
Yes.
Yeah. And then you marry that with other administration policies. I mean, the Trump administration has been, as we all know, incredibly hardline about immigration, and construction being a sector that relies on plenty of migrant labor, that can stress things. Even if we're talking heavy construction, where you may have less migrant labor, I think that across the industry, when it starts to trickle down, that you have less workers available, that it has
right. They all become
and so then you're so of course your capital costs for materials go up, but your human capital costs are also skyrocketing, and it just becomes untenable to be able to build out this sort of manufacturing that the administration is demanding.
I mean, what they seem to be talking about there, goes back to sort of the way Japan developed in the 70s and 80s, where that was driven also by having a large amount of unproductive labor that, stands today in the U.S. we just don't have.
I will also say SCLAN, you called out Clinton and NAFTA. I will say where I am based, so I'm kind of around Virginia, more Appalachia area. That really was the death knell for a lot of the manufacturing we had here up the 81 corridor around that time period. That's when we saw a lot of stuff take off initially for Mexico or Canada or China, and ultimately it never came back. And there's a lot of communities around here that have since had to shift their industry since then. But just that happened so long ago that a lot of those people, like 30 years ago, their skills are gone. We still have to rebuild those skills again. We can't just open it up overnight and just put a new manufacturing facility in those communities.
Yeah, I mean, oil and gas, where I generally work, is one of the more flexible industries for labor, where you can just sort of like start and stop projects. And, what it pays to do that is your sort of unskilled, like field labor personnel cost you $120,000 to $150,000 a year a person. And you have to pay that much or people won't deal with how uncertain and, risky that work can be. And I just don't see how, American manufacturers could possibly pay that much and make the items the administration seems to want them to make, like t-shirts.
Yeah.
So there's a whole even if you're just thinking about like let's bring manufacturing back. I mean, I keep hearing we've got factories ready to go, but if you look at the broader market, as far as like the economy, you're seeing every step of the way it has to get rebuilt. You got to figure out, can I even do this domestically? And if I can't, can I weather the tariffs until I can? And I just don't think there was a lot of thought. I mean, it feels like a lot of this blindsided even the people on the Trump side's economics, that they just went to 100 right away. And that has unsettled a lot of people, because you want people to kind of ramp up this production domestically, and where each step of the supply chain kind of gets moved to the domestic market. That was like what I see as like the plan a lot of them had. But now it just feels like we're just trying to turn I mentioned in markets earlier, trying to turn the heat up on everything without any regard to what the economic effects would be.
The thing is,
seems to fit with the way Trump implements policy.
But he
is not a subtle man.
Or anything that takes a little bit longer lead time. If you didn't start doing this the day he got elected, to pivot to a place to be ready for this, now it's too late. You're not going to be able to really do this without major capital expenditure.
Yeah. Yeah, and some of these timelines, if you look at parts of the supply chain you're talking about, unless you literally saw him coming down the pipeline and you were like, oh, we got to do it now, and you took the investment like 2 years ago, you're behind. You're way behind, even if you started when he got elected.
And if you did that and this doesn't happen, your competitors destroy you.
Exactly. Yeah. Yeah.
Everyone who didn't do this,
stability. Mm-hmm.
You tie up a whole bunch of capital building a factory because you go, okay, I think Trump's going to be reelected and I think he's going to do this tariff thing. You need him to win. Then you need him to do the tariff thing, and then he has to keep doing it for years for that factory to pay off.
I don't know if it's going to be some of these groups. I honestly think, because at the end of the day, the factory's still going to be able to raise costs and increase their revenue and profit margins while still being able to undercut the competition that didn't plan. They might possibly be able to see it get paid back. Not within a year, but probably before the end of this administration.
I mean, so normally when you're financing like a big capital intensive project like that, you're looking at your cost of capital being about 10% a year. And sort of your hope when you do that project is that the value of that factory with that cost of capital is positive at the end of 10 or 15 years. And so it's very hard with the way sort of the political system works for you to make those kinds of decisions based on the political environment. You're going to have two or three administrations that come and go while you're running the factory to pay off the capital that you borrowed to build it. I don't think it was realistic for the administration, even if someone, say, during the first Trump term had gone, I think he's going to do this tariff thing or this great idea or whatever it is, you still wouldn't really be in a position to deal with this because Trump's only there for 4 years. So you have to believe that not only does this happen, but it continues, and that whatever administration follows Trump also has this sort of, let's call it, unorthodox belief on trade. But do you guys want to take a couple of questions from people in chat?
Yeah, I think we can
some of the statements. I was going to say real quick, Monarch is a mod. You're right about the low cost or labor intensive goods. Even in the U.S., an assembly, someone that's working in an assembly position on the manufacturing line is probably 10 to 20 times the cost of their European counterpart. And you're ultimately going to want to try to find ways to automate that because you're going to raise your costs on those low cost goods significantly.
I mean, you pretty much have to go to automation where you can there. I mean, it was the thing I talked about. We're in oil and gas to keep sort of uneducated manufacturing labor where they're mostly using welding equipment and things like that. You're paying at least $120,000 a year. And that's where it starts. Like that would be a 19-year-old with a felony conviction and 2 DUIs. So someone's got to drive him to the rig.
I think one of the issues here, Astra, you're talking about capital costs and repaying that. And just the borrowing costs associated with that, and the economic uncertainty that we're walking into. On one hand, we expect inflation to tick up due to the tariffs, and historically, the Fed has responded to increasing inflation by hiking rates. And but in contrast, if you get into a recession, you typically cut rates, and that gets us into this sticky spot about how does the Fed respond to rates. I mean, already we have Powell's comments a couple days ago that and he's really trying to play a very middle of the road approach, but within what he's saying, I interpret it as don't expect any rate cuts this year, even though we were typically expecting 1 to 2 cuts this year. Probably that's out the window. But just over time, how does that affect? If you are trying to bring your manufacturing back to the U.S., how does that impact your borrowing costs and what it takes to pay that off?
Yeah, I mean, one of the things Powell's brought up in the past is essentially that the job of the Fed is not to fix bad policy. That if there's an incredibly inflationary government policy, the Fed has to hike rates into it because that's the main driver of what they're doing. One of the things people are talking about a lot on chat is, the different sources that exist for labor, whether that's, RFK's ADHD camps, which could be the most fun or worst place on earth, depending on who runs them, or, things like prison labor and those sorts of things. I think one of the things the administration may not fully appreciate is the scale of the labor problem we're talking about. That internationally, to feed sort of U.S. consumer consumption, you have something like 200 to 300 million people who are employed doing that. And so you need, whenever we talk about different ways the administration might try to address it, you want to keep in mind the scale of that idea, that, you know, coming up with 2 or 3 million felons gets you maybe 1% of the labor you're trying to get.
Yeah, and I mean, there's a comment here a few minutes ago from AlphaQ. They said, I think one thing people don't realize is that even many U.S. manufactured goods not dependent on trade will increase in price simply because they can raise their rate of profit while staying price competitive. And I mean, one of the anecdotes I keep going back to is, you know, in a similar vein, because this does involve trade. But looking at cars, I bought a new car back at the beginning of the year, and it's a Subaru. My trim level is made in Indiana, and certainly it uses Japanese-made parts, and so that will be impacted by the tariffs. But if we were just looking at an even playing field and disregarding the parts tariffs involved with that, the next trim level down is built in Japan. And so if you have one trim level, the cheaper trim level being built in Japan, and it's being tariffed, 25%, and you have a trim level built in the US that's higher, typically more expensive, that doesn't have, let's assume it doesn't have that tariff rate on it, then all of a sudden you're going to end up in a world where it's theoretically cheaper.
All of your pricing doesn't work.
Your pricing doesn't work. So you're going to have to raise prices across the board, even for your item that isn't theoretically being tariffed or isn't subject to tariffs to the same extent. And so it's not an even playing field, even for goods that are manufactured in the U.S. And so whether your goods are 100% U.S. manufactured, you don't have any tariff implication whatsoever, and all of a sudden you can now raise your prices because you can you're factoring in all of that. Or if you have to raise your prices because you have goods that are made outside the U.S. that are at a lower tier, but all of a sudden they cost more than your higher tier goods, well, you're going to raise your prices on your higher tier goods too.
I mean, that
for me being, I'm just going to say quickly, for me being, of the mind that markets are broadly efficient and that sort of thing, it's also that, okay, they raise their prices and everyone else raises their prices beneath them. If your auto manufacturer raises its prices 20% because it can, then the American suppliers to that auto manufacturer do the same thing. Its workers do that, and everyone does that. That sort of inflationary tendency that exists goes sort of all the way down that chain.
REI. I'm going to get back to that one after Clear speaks.
Sorry, I just got a phone call.
I did notice we're all much more polite when there's a big audience. Generally, we're interrupting each other more and sweary.
Oh, very much so. Somebody's recording this, so that's part of why I am. So the big thing to me, I was literally walking through and we were doing our grocery shopping and kind of, in anticipation of all this chaos, kind of going, what's stuff that can just sit on a shelf for a couple of months? And we're looking at all the stuff that's getting imported, and I had the same thought, thinking, we buy like California olive oil, but then I was sitting there and I was going, oh no, that's going to go up because it's going to be the only thing there. And then what does that production look like, and how constrained is that going to be? It can't ramp up. Like, a lot of this stuff can't ramp up quickly either. So you're going to have that kind of lull where we're all going to be paying higher. And then does that higher price stick? That's to be seen.
Well, and in a way it has to, because you don't have, even if you get rid of the tariffs 6 months later, your, say, olive oil manufacturer has already had to raise the wages of its staff and do all these different things to try and expand in an environment where you just don't have, it's not as though the U.S. has like massive unemployment or something where you have these the sort of waiting pool of labor and people trying to, do something productive. Every job that goes into, I don't know, making pots and pans, sewing heads on stuffed bunnies, or making olive oil, that person isn't doing whatever they were doing before. And generally in a country like the United States, that means that they're going to be going from a more productive activity to a less productive one.
Yeah, and we already have this year a chilling effect on cheap labor that our economy's relied on for years. Whether or not
there is
the moral part of that. But go ahead.
Well, they'll say that, there is the version of this kind of policy where you implement a lot of protectionist measures while at the same time going to really open immigration policy. And the idea being, okay, you want to build these things in your country instead of, and with the people who come with them, instead of them being, built somewhere else.
Yeah, that's not the reality we seem to be facing from a policy perspective.
I mean, it's pretty much a recipe for disaster, isn't it?
I mean, one thing, I think it's HCM in chat, kind of asked about is it too late to get manufacturing back? And I think, when you look at that, at least on the financial industry side, it's, manufacturing in developed countries is difficult to do. Developed countries tend to have, higher costs of labor. They have higher environmental controls. They have all these, things that go with hiring the people who live in those countries. And so you tend to see where that's been successful. You see a lot of things like automation that come into it, so that the amount of value that the company derives from each individual worker is higher and matches the value that that person generates doing services work. You don't see developed countries go to things like assembly lines, or one of the things that people used as an example is trying to onshore manufacturing things like clothing from Vietnam. And for an American worker who, I forget what the average is right now, say it's $80,000 a year, each individual worker in that factory has to count for a ton of t-shirts to pay them $80,000.
That'll seep into inflation as well, ultimately.
Right.
You basically.
Well, that they have to, if we model that out really quickly and say, okay, you want to get $1 out of each t-shirt for the worker, it's okay, what sort of equipment, what does a factory look like that allows an individual, for each person who works there, we need 100,000 t-shirts to come out. And so you go, okay, we're going to have a small factory that's say only about 100 people, and it's supposed to make 1 million of them a year to pay those 100 people. We didn't make that many jobs. The level of productivity that's required in a developed country to pay those workers is just massive. And I think that's why you see things like cars, aircraft. There's a lot of U.S. manufacturing in industries like oil and gas where the equipment involved is really expensive. And so you can spread the cost of your workers over a smaller number of units.
I think
their tasks that lend themselves to automation.
I think a smaller scale story, in its service sector, it's not manufacturing. But when we're talking about sudden price increases and consumer reactions and cost of labor and things like that, that I'm based in the DC area. And a few years ago, DC passed a ballot initiative known as Initiative 82, I-82, which over time gets rid of the tipped wage in DC. And currently the DC minimum wage is $17.50 an hour. This summer it goes to $17.95. And so over time, the restaurants in DC and won't be able to pay out at the they won't be able to take a tip credit on wages, and that's led to most restaurants here in the area implementing a service charge. Some have kept that around 6 to 8%. Some have made that 20 to 25%, and sometimes that's going directly to workers. Sometimes that's kind of just going into a general operating fund, but it's helping pay the increased wages because they're still taking partial tip credits. But
right, well, consumers are more amenable to having that as we charge 10% more because we have to pay our workers more. Being explicit that way rather than just my menu items just cost 10% more.
Yeah, I mean, instead of raising prices directly, these restaurants have implemented these service charges, but there's no clarity as far as but restaurant to restaurant. Some restaurants, it's like, yeah, that's completely replacing your tip. Some places they're still expecting you to tip on top of whatever the service charge is. And a couple weeks ago, the DC area restaurant industry group, they published a survey that 44% of restaurants in DC are saying that they might have to close this year because this was passed with really limited consideration as far as how does this impact economics of consumers going out to eat, and but really the labor costs involved for the restaurant industry. And as much as can be said about tipping culture in the U.S., it's a ingrained part of our economic attitude. And I think similar is true with manufacturing, that we've seen such a decline in manufacturing that we can bring it back to some extent, but it's so fundamentally different from what we see as t-shirt factories in whether that's in Honduras, whether that's in Vietnam, China, wherever. And so this idea of just we're going to bring it back, it becomes difficult to work with for a lot of companies.
So with textile, go on. I was going to say with textiles, basically, it's pretty much impossible to bring it. It's very, very difficult to bring it back. I mean, you're looking at Bangladesh and other countries, and like Vietnam included, and they've basically specialized in those industries. I think it's important to point that out. Whereas the US in what Trump he wants to achieve is essentially diversification. I think it wouldn't necessarily work when it comes to manufacturing again. The US is already a services-based oriented economy, so I just don't think
Cricket's telling us that we're not going to have clothes.
Well, so I wanted to push back on two things that we had just mentioned here. First, comparing restaurant labor to manufacturing labor is, I understand where it's coming from. However, manufacturing labor in most areas of the U.S. is still above minimum wage. So in a lot of ways, what's happening with the raising the minimum wage isn't necessarily putting direct pressure on being able to, afford to produce that widget in a manufacturing line, but it is causing you to have to push up wages in a more long-term way. Is everything else in the community becomes more expensive.
And the manufacturing that's performed in the U.S. tends to be either higher skilled, or there's an apprenticeship process, or there's, in the case of oil and gas, there's physical danger.
It's high value parts.
Right. And the U.S. just doesn't have you don't have sort of this industrial base of people who do make near minimum wage doing sort of unskilled assembly type work. One of the things that's come up that I've talked to a couple of people about with the tariffs is also that tariffs generally apply on the value of the item that's imported, and how one of the reasons you historically have seen this huge push to free trade is that using tariffs and duty that way tends to be very technically difficult to do, because companies are very strongly incentivized to cheat, or if not cheat, let's call it optimize the way they deal with the tariffs. And so that turns into things like, okay, well, with my t-shirts, I could still get all of, 90% of the work done in Honduras, and then just have a robot in the US that just, staples the two pieces together. And so you see a lot of weird sort of industries where you sort of break up how a product is made, not for a industrial economic reason, but for a tariff optimization reason. And with 20 to 30%, you have a lot of slack to do, to do that kind of change.
When you do these tariffs across the board like that, though, and when it's not across like the HTS category, it's actually country to country. It's going to be hard to find economics of getting something partially assembled and finishing it here in the U.S. So try to avoid tariffs.
The example I would use with people for this is, let's say we have a stuffed animal factory, and we'll assume that it's in China, and it's for tariff declaration purposes. What is the incremental value of, say, a stuffed rabbit's head? And it's realistically, the value of a stuffed rabbit's head is mostly the stuffing and fabric that goes into making it, not the fact that it's happens to be rabbit head shaped. The same's true of the stuffed rabbit's body. Its value is very, very low until we put the two things together. And so what you see a lot of, and we see this some in oil and gas, when, say there's a country that has very high tariffs on heavy machinery. What you would do is you import all of it in 2 or 3 pieces that individually have very little value. And then you do the value add in the destination country of, okay, well, we're going to do the final assembly step that takes this from being, 10 cents worth of stuffed animal head and 15 cents of stuffed animal body. So we paid 25 cents in tariffs on that. We pay people to sew the heads on the bodies, and then we sell them for $30. So you see a lot of sort of gaming that, particularly with these kinds of products where you do each step is fairly arbitrary.
We will see how long this admin permits something like that. It doesn't start trying to do things to discourage that. So I think it's a matter of time until that pisses them off.
Yeah,
I also wanted to say that as we talk about wages here, some states, I'm forgetting which ones, I think Alabama is one of them, they permitted per piece labor again. So you could conceivably pay someone per piece when you're manufacturing something like a shirt, and in theory, maybe not pay them the full minimum wage, depending on if the feds are willing to step in on not on that. And that might make some of those states more competitive for this kind of manufacturing. If the labor pool is accepting it.
I mean, that's something that I noticed in, was it Texas? I think it's Texas, New Mexico, and I think you can here in Nevada. That's what a lot of places do now with things like, say, kitchen cabinets, where their workers are paid, $30 a pop to install them.
Yeah, that's still pretty high value, though. I'm thinking.
Well, and it's taking that same model. If you keep going down, if you're a really slow kitchen cabinet installer, you could end up below minimum wage. But when you take that same thing and you apply it to T-shirts, and it's 50 cents, not $30, it's easy to see how you could theoretically run this as far down as you needed to, and I think that's where you get into the problems with the labor pool itself, where ignoring the morality of running a company that way, how do you convince anyone to do that?
I just don't think people will accept it. People simply in the US or in the West overall, people just won't accept that form of payment. I think therefore just completely wouldn't work. But it's interesting to think.
I don't know, because
if you set the amount high enough, presumably most people would accept sort of payment by work piece. The problem I think you run into is there really isn't anyone who's going to give up their current job, whatever that might be, to go do that. It would work if you had, say a massive group of people trying to immigrate and you were kind of letting all of them in. You could come up with a way to make that work by saying, okay, this is a job that pays enough that you could start to get established and do that sort of thing. But, it goes back to the kind of conversation about anything that someone does in these new factories means they're not doing their old job. And so the factory job has to pay roughly what their old job paid to get them to agree to do that.
So one of the things they could do here to kind of access that labor pool, or to access the labor pool that might be more willing, is they could start bringing back work requirements on Medicaid again and SNAP benefits, which is something they tried heavily during the first Trump admin. We haven't really seen them try too hard this time, but the regulatory landscape and legislative landscape for that is more favorable now to making someone work for Medicaid or work for their SNAP benefits.
That is something. I think I'm the only person here old enough to remember, the whole thing with welfare becoming workfare and that whole thing under Clinton, where some of those benefit programs turned into okay, you have to be seeking a job.
Yes.
And I think the problem you really run into is if you look at even say the SNAP benefits someone receives, the dollar amount in benefits they receive is still more than you can pay someone to sew up a T-shirt. There's just not we're orders of magnitude apart from places like Vietnam that have built this entire industrial base around having cheap labor and the materials available.
And I also want to add, for most people's edification here, the way we pay prison labor here in the U.S. usually is per piece, and it is usually sub 50 to 20 cents per piece. So this is something that isn't totally foreign to being done here in the U.S. It's just we typically don't see it outside of prison or incarcerated populations in the sub-dollar per piece realm.
So I I've had this kind of inkling that there might be something like if you wanted to achieve that kind of like market shift where there's already like set up people paid for these kind of jobs, you almost need like a massive amount of job destruction and then recreation, which like with the transition from taxi to Uber and Lyft, where you just end up with this massive shift over. It's a completely different system. It's a different employer. That's the kind of thing that you'd have to have. And I don't think anyone, I still, every once in a while, I think about the fact that we have low unemployment and that's driven some wage growth. But I do have this kind of like worry that somebody in the administration might be stupid enough to think, what if we just blew stuff up a little bit to get that kind of economic shift?
I mean, and the tariffs definitely do that. You have, if you sort of play that whole thing out and you go, okay, well, we want this shift. And the only way to get there is going to be to destroy a notable segment of the current sort of employment for Americans. Doing things like dropping massive tariffs out of nowhere will do that. I think the question is it possible to end up with the same or more productivity out of those workers? When Japan did this experiment with protectionism and that sort of thing, they found it really wasn't. And that's why you had, the lost decades with Japan, is you have the actual productivity of workers didn't go up, so you kind of couldn't go anywhere.
And we have a question from Ray, like, could this whole, like, we want more people in manufacturing, like, could that be part of why they're riffing Fed workers? And I don't think that that's the cause for the rifts. That this is a administration that seems to be hell-bent on we want a small government, small in quotes, because we'll see what actually comes of it. But certainly that's been some of the reaction, I think, that that they're not necessarily firing all these Fed employees to provide a manufacturing workforce, but people have been saying that, well, they're all getting laid off, and so they can go take jobs in manufacturing. But I mean, again, these are a lot of people who have very specific skills. They may be able to make comparable money in manufacturing compared to what they made in government. Especially, government's not always it isn't always high paying, but it's going to pose barriers. I don't think that that's the reason for firing all of them. And then
also there just aren't enough of them. Like, yeah, if you go, okay, I want to make T-shirts out of fired with Fed workers. It's okay. We fired all of them, and we've covered 3% of the labor that we need.
Yeah, I mean, I don't even think we've talked about getting into hundreds of thousands yet. I think we're still somewhere in the tens of thousands. I want to say, even though with planned layoffs, it's not going to get close to covering everything. Then real quick, because we've had Clear join, we did introductions with Moto, Astro, myself. We've had Clear Signal join, and then we have Cricket who joined. Do y'all want to do quick intros on y'all's background real quick?
Sure. So I've been in Project Alpha for like 5 years now. In terms of my background, I've had some experience in economic research. I personally study economics as well. So in terms of an academic and work experience background there, I have that. Anything in particular you want me to cover too, in terms of my background, or is it just general?
I think that works.
Yeah, that's great.
Yeah, so I'm Clear Signal. I've been here forever. But my background is I've worked kind of cross-sector, across multiple sectors, private, public, everything like that. And I've applied that and experience here to watching the markets and kind of watching trading in crypto and stocks and just kind of a retail trader background. So I'm kind of bringing that to the table, just looking at different sectors and kind of talking towards issues there.
And I think that sets up a good transition. This whole sort of idea for the talk started out of a lot of the discussions in market and finance where people have, okay, what do you think the market's going to do with this? And what could retail investors do, or what's the best way to handle it? I think my big takeaway from this conversation and others that I've had is that no one really has a great feel for how to make this work. And so that means that, there's not going to be some the whole market and every company piles into one way to solve it for those companies. There's no clear cut good move for them to make. So to me, obviously that suggests that what we're looking at is mostly inflation and volatility, that it's not, it'd be very difficult to do things like, try and position yourself well with individual companies, just because the way each individual company reacts is probably going to be very unique to the circumstances of that company and the sector they're in.
I do think, as far as like the investing angle of it, this entire thing, except for a few smaller elements right now, is predicated on future events, future things, and maybe some people taking bets on what's going to happen. We're not dealing with like a crisis of some instrument failing, some bank has done something and now there's no money in something and it's collapsing. We're talking about planned policy implementations. Like, we have one set in place now. We're still waiting for the other one to come in. And the uncertainty that it could just either it stays forever or it evaporates tomorrow, that's a huge gap of uncertainty. Like, how do you navigate that as far as the investors' sentiment goes? Because the volatility is everywhere.
So I posted a series of charts in the text chat here. That's a couple of currencies, the S&P 500, oil, natural gas, and then some precious metals. And one of the things that strikes me looking at it is normally these assets don't correlate. If nothing else, gold moves differently than everything else. It's interesting to see an event where there is strong correlation with everything. That normally kind of can't happen.
Right. Usually you walk from one side of the room to the other side of the room. Somebody's left the room here. Some group of people,
right?
And we've said that it's probably cash, right?
Right. Well, it has to be, because you don't, whenever you sell a stock or you sell any financial instrument, you're left with cash that you then presumably normally would put into something else. So you'd go, okay, I think, this is going to be bad for U.S. companies. I'm going to sell my stocks and I'm going to buy, gold and inflation adjusted treasuries or something. And what's particularly strange about this is no one's doing that. You don't see the spike that you would expect to see in gold. You don't see the spike you would expect to see in other currencies. You don't see it in equities. Traditionally, sort of the way you deal with inflation as an investor is avoid things like bonds. Equities tend to outperform bonds with high inflation because they're tied to the underlying assets of the company. Or you go into things like precious metals and, sort of all the other flight to safety things that people do.
Yep.
In this case, we don't see them doing that, because the same sort of thinking and policies that create the uncertainty and the risk and making people want to sell, it also means you don't really want to go into something like, say, U.S. Treasuries, because, Trump decides that the Treasury rate is exploitative and he's not going to pay something. You can't. The whole point when you're doing those kinds of things is changing what your risk is and what you're exposed to. And I think one of the things that this whole set of policies has done is shown that, if you have a U.S. administration that thinks in this way, you can't really avoid exposure to that risk. That if you were to, say, sell U.S. stocks and you're going to buy companies, say, in Europe, where you're still impacted by that set of tariffs, you can't, for investors, there's no sort of safety to flee to. And then that means that all the money that's coming out of the system right now, it does literally just sit as cash, which it can't really do for very long. And that's something that generally drives inflation incredibly strongly, because if you're stuck with cash and you don't like your options for investing in, none of them seem to deliver a return, or they seem too risky, or whatever it is, you spend the money.
Yep.
Because at least if you spend the money, you have a thing, and so that's something else on the inflation side that, totally ignoring how the tariffs work. Even if we just assume magically it all just happens, you still have this massive amount of cash that's come out that, it's nowhere near enough money to pay for, say, building all these factories. And we've talked about all the different risks that go into doing that. So it's probably not going to go there. It doesn't seem to want to go into treasuries. It doesn't seem to want to be precious metals. It's not going into equities. And you run into this question like, okay, well, where the hell does that go?
I mean, like, I know there's like, no, I was going to say some stuff about municipal bonds, but it's like, that's not even a thing really for this. But, you know, for a little while there, because I saw this mentioned elsewhere.
And Alpha's correct. They should go with Pokemon cards.
That is a good one. I do appreciate that one. Mine have held value, so that's good. The thing that I saw mentioned elsewhere was that
with Pokemon cards from Clear Signal. There,
I'm just saying.
They're a great store of value.
It's going to be my inheritance to my children. So I saw somebody else say that, which is kind of an older way of thinking about them, that crypto at one point was the flight to safety for a second for some of the more volatile traders that were like looking for a game to play. And that seems like it's kind of died off, and now we're getting this kind of linkage where the market goes, the cryptos kind of go too. Which I wonder if that's linked to that we've got more institutional investing, and so then not sure if that's shifted things a bit. It's like it's not a safe place to keep your money, but it is definitely a game to play, and I feel like we're seeing some of that play out now too.
Well, and it used to be, you know, crypto's very much tied to sentiment. I mean, even more so than other asset classes. And so, you know, I think you have a thing where when people are nervous, they kind of close out of everything. It's not, crypto tends to correlate now pretty well with, you know, like microcap stocks and other things along those lines that have similar volatility profiles.
It seems like it's almost included in certain portfolios now, that when they act on their smaller stocks, they also are acting on their crypto. Like, how do they feel about it? The whole thing as a set. I don't know how much that ties into things. That's just the feeling I get from when I watch things go up and down. I kind of see them move together.
Right. Well, and that's, you know, normally going to like the institutional investor perspective, one of the things you look for are assets that don't correlate with each other. You know, that because what you're looking for are things that can regularly deliver returns, and they don't. You know, sort of the classic set would be, say, the S&P 500 and gold. That if you think the market's going to go down, you can buy gold, and if you think the market's going to go up, you can buy S&P 500 or futures on it. And so, you know, normally you saw a fairly strong negative correlation between the two assets. And what's been unique with this as an event is that everything is fairly well correlated. And so, you know, it goes back to that, okay, you know, every single trade someone does, there has to be a counterparty. You know, if you sell something, there's someone else who's buying it. If you buy something, there's someone else who's selling it. And usually what that means is that for them to buy your thing, they had to sell some other thing. Right. You know, so you almost have to have something that has a negative correlation because it has to be the thing that other person is selling.
To the ravenousness of activity, right? Like if you have a lot of people looking to get into things, it'll drive stuff up. I mean, this is simple. Like this is the basis of what's happening in like market buying and selling. Like that's really, really rudimentary stuff what we're talking about here.
Right. Well, and now, you know, notably a lot of the development around how you price those things and how you think about those things is no one's thought about tariffs like this since that happened.
Right. And that's why you get a lot of people who are asked questions about it. And I feel like they try to fall back to this traditional model, and they're just like, well, you know, it always turns out okay. And it's like, well, if they are really trying to change the way the status quo works, there's gonna be a lot of people who are just like, they have to find some new way of thinking about it and talking about it. You're kind of shifting this fundamental how we've operated for what was it? What's the last time? Like I want to say it's like almost 40 years, right? Like we haven't had something even close to this. And then that's just a sort of thing from like the Reagan era of doing things. And even before that, you go all the way back another 40 years.
Right. One, you have to go to find this kind of thing discussed as like a serious policy conversation. You either have to go to like the 30s or like the 1880s. And that predates a lot of the theory and a lot of sort of the work that went into the idea behind sort of the modern market, you know, efficient markets thesis. And so that means that the models that you can go off of that people have come up with don't have the same assumptions that, say, an institutional investor has. You know, pretty much every institutional investor that currently exists is either going to be someone who believes in very efficient markets or someone who very much believes in, sort of rates as market intervention, because those are kind of the only two schools of thought left standing. And so all of sort of the financialization stuff that's happened over the last 50 years is built in those two frameworks, that sort of like those are the only two ways this can possibly work. And all these policies we're looking at aren't even really contemplated in those systems. They would just be viewed as like destructive. The whole idea is that you have rational actors, and if you don't, none of that economic theory works.
Rational actor theory in today's day and age.
I mean,
Usually people at least want to make more money.
The basis of this kind of like the way they're operating, we can literally right now. It's so funny that it's happening at the same time, but I mean, obviously it kind of has to. But look at Iran, the whole Iran-US thing. We've got this whole brinksmanship, I'm going to destroy you kind of approach that Trump has to his foreign policy, that I'm going to make it seem like I'm about to level the whole place before I go to peace, right? You bring that to economics, you get that kind of uncertainty. There's a whole lot of side effects that happen. It's not just we can just go back to what we were doing because this is how it works. It's a whole new ball games when you're winning the actual, like, it's not business that's doing this. It's not a strong arming another business to sell to you. It's you're the government and you're doing it, and it starts an entire different dynamic of uncertainty.
In that, destruction doesn't generally happen from the specific policy. If you told every company in the United States, that next week all their stuff was going to cost 15% more, and you didn't change anything else. You just said, we're just going to do this once, and I don't know, we'll use the money to pay down the debt or whatever. Business would handle that fairly well because it's very predictable. So everyone goes in and they adjust the models they're using and they say, okay, well, this happened. And so now, this factory has to earn a 2% higher return, or this asset's not, this isn't going to cover the cost of capital or things like that. With this, the destruction doesn't really come from the financial side of the tariff so much as no one has any idea what asset does well. If you look, through the chat, everyone's talking about, here's what gold's done in the past and what people do with bonds. And, one of the things we talked about earlier is, when everything's going down, what that tells you is the money isn't really going anywhere. It's just sort of sitting off to the side, waiting for someone to have a plausible thesis for where they should go with it. When we talk about this dollar amount, I think, what was it, on between Thursday and Friday, there was something like $9 trillion in value that was removed. There aren't a lot of asset classes. Well, there just aren't really that many asset classes you can throw that much cash into.
Yeah, I mean, and a few minutes ago, there was a question from I Have the Storm, like, what are people buying, though? And Astro, that's what you're talking about a little bit ago, that it's like, this is going into cash right now, which isn't sustainable long term. And so I think that's kind of what the scary thing is, that people are pulling money out of all asset classes, they're putting it into cash, and that whether they end up going and buying products and and driving inflation, or even if that cash is just sitting. I mean, and I don't, as much volatility as there is, as irrational as the administration is, and as much as we don't know what's going to happen, I don't see bank collapses and or bank runs, or even the FDIC getting taken away. I don't see that particularly happening, but it poses an issue for institutions if people are pulling out of investments and just holding cash. Even if they don't spend that cash and they're just holding it, then that can lead to issues, for various financial institutions.
You even just get to things like, say, for a bank, and it's reserve limits and things. You can't throw $7 to $9 trillion of cash into banks because they can't do anything to earn a return with it either. So there's a chart I'm going to post. This is the future spread on crude oils. This is what I was looking at this morning, where it was really obvious that the market has no idea what's going to happen.
There's some wonderful drawings of spiders you've sent us.
Yeah, it's like, those fireworks on the ground that, they...
I will say,
normally you have like a nice curve that's, if inflation's going to happen, then, the back prices are higher and all that. And with this, it's just like, well, who knows?
So I will say, and this is really more of a question to y'all, but as we're talking about these asset classes, we've been in kind of like a venture capital winter here for about 5 years, where returns were so great in other sectors that no one wanted to put money into venture capital firms. And I've been wondering, is now the time where we see additional money flow into these VC?
I do think in this environment, it is probably a lot easier. So just speak more from like the private equity side of it, it's a lot easier to raise money in those sectors with this kind of environment because you're sort of counterintuitively, your risk premium becomes lower because everything is risky.
Mm-hmm.
Your risk premium is driven by like the difference between the risk of this and the risk of that. And if everything's incredibly risky, then it's like, well, screw it. Go for something where you might get, 10, 20, 100 times your money.
Right. If you see them as like tables, like if you're looking at like a casino floor and you see them as tables, suddenly all the games are risky. Why not go for the one that might have a high payoff? Like you're looking for the game to play.
When you do with venture capital,
that was kind of a loaded question because I've already personally, I've taken some risk here at this point since the beginning of the election.
In venture capital,
it seems like it might be the place to go.
Well, in venture capital, in a lot of ways, behaves very similarly to sort of consumer spending, where if you have really, really low risk, it goes up. And if you have really, really high risk, it goes up. In the middle, everyone puts their money into stocks and bonds and things like that because you get a pretty solid return because there is some risk, but, there's not a massive amount of risk. It's not the biggest problem I see with venture capital in that role is really just a scale problem. That if you are an institutional investor or you're a family office or you're someone who manages a few billion or $100 billion, it's incredibly labor intensive to analyze assets. And you're constantly spending all your time trying to find the next things that you're going to put those assets into. And the problem
there just isn't going to be trillions of dollars worth of startups to put assets into.
Well, so what happens is the sort of startup economy will grow to soak up as much capital as people would like to burn. That what happens is the quality of the ideas that get funded goes down, or the average quality.
Right, and your due diligence isn't there to really
and
find those out.
And it's important to remember those investors on the other side of that are in many ways compelled to participate. They have to place the money. They can't just sit on billions of dollars in cash. And so even if they want to do a lot of due diligence and they want to make good investments, what happens is, on say a given quarter, you may have a list of 150 things that a firm's going to look at. And basically they'll fund it from the top to the bottom. And so more things get funding and riskier things get funding. But at some point, you're working with those companies, you have meetings where everyone in the meeting knows that an idea is bad or that the people who are trying to do it cannot do it.
I've been in many of those. Yes.
But you end up investing in them because you don't have a choice. You have $50 billion to place. And so, these people suck, but they seem to suck a little less than the other places we could go at the bottom of the list. So fine, maybe they won't destroy all our money. Maybe we'll get half of it back when we sell their office furniture. And that you can do that. It's just as you have more and more money in that system, the quality of the businesses that get invested in tends to go down.
Well, it makes everything very frothy. Right. Not necessarily a bubble, but you have a lot of little things that happen like that. I feel like I've been through now 3 waves of them.
I've been
where you end up with software.
At this point.
Yeah. Yeah, there's plenty to pick from. But back in I want to say it was 2010, when video chat became really big, there was a whole lot of VC investors who would go through and jump on chats, and it seemed like everyone had a VC at that point, down to like individuals who were like, I'm doing this thing, there's a bootstrap website, let's give me some money.
That still works.
That still happens. Yeah, no, I know it's still a game that you can play. It's just not as well. Now they're React websites, so yeah.
So that's interesting. Marty,
so one
question that is something really interesting.
So we'll go over that in a sec. There's one thing Tony brought up about how mass wealth equality, is that a prerequisite for having so much venture capital to go into, let's call it, bad ideas? What's interesting with that is when if someone's managing money, whether it's their own or other people's or your CalPERS or your whoever, the whole time you're doing that process, you're constantly seeking places to put money. Your compensation is driven by the return that you earn and how much money you're managing. So if I place an extra $50 billion, my firm, may earn an extra $1 billion in fees, even if there's no return from that money. So you're constantly trying to find places to put things. What wealth inequality does is moves that, kind of decides whether you're more playing on the private investor side, where the way you tend to get private investors is a narrative. You have a story about why your product is revolutionary or why your idea is great. And either they're super enthusiastic and they buy into it and here's some money, or they don't and you stop talking to them. With institutional investors, it tends to be more about how your product fits into their investment thesis and their sort of model of how the financial system works. Does it seem like this idea will earn enough return to cover the risk of the idea? They don't believe in you or not. They just sort of, it fits or it doesn't. On Marty's link that he posted about, trading desks. So I was working with a company that was trading on SGX during one of the fairly large Asian crashes in 2004. And that whenever there's a lot of volatility, you call in all of those people. It's not, you have a lot of assets that you have to watch at the same time, and you're trying to figure out how to de-risk them. And so on the risk management side of those firms, you have various rules around the assets you own and how you deal with them. And you can cut things a little closer and work with a little more margin if you have more people working that set of assets. Theoretically, if you have, one person for each asset you have, and they're just watching that go up and down, then okay, if it starts to go down too far, you have an individual who's going to be making decisions about it. When you're less staffed, that process tends to be a lot more automated. The problem you have there is kind of the same problem ETFs have, where once it starts moving, it moves really fast. We talked about it earlier that if you want to sell a stock, someone out there has to want to buy it. That every trade has two parties. And so that's why things like crashes happen so quickly, because if I want to sell stock and no one wants to buy it because it seems horribly risky or Trump's going to screw it up with tariffs or whatever it is, its price goes to zero. There's some level at which people will buy, but we don't really know where that is. But if you have that, active management for the asset, then you can cut that a lot closer than you can just going like, well, if it goes down more than 10%, just dump all of it, which is kind of what the automated systems will end up doing.
I mean, that's what you see a lot of times in the market when you have this sudden, just feels like the floor comes out from under you, is that, and the specific stocks. Though I did see it last week a little bit with the indexes, so I wonder if there's something weird about ETFs or institutions where they have like the institutions are indexing things or marking things on the indexing saying we're going to move here.
So one of the things you have if you're doing risk management at like a big institution, someone like say BlackRock or Goldman, is you have some points that on your risk side that become automated because your risks have exceeded the firm's tolerance. And now you don't care what's going on, you want out.
Makes me think of, they were talking about margin calls over this weekend.
Right.
It's like an internal version of that. Instead of you imposing it on someone else, you're imposing it on your own.
Well, and so a margin call externally, say with your broker, you actually have some slack in that process. Usually with most firms, it's like 3 to 5 days normally. where they'll say, okay, because normally when you get a margin call, it isn't because of a huge event. It's just because you've screwed something up.
You just got to rebalance because you've
right,
come out of the track.
Right. And so what happens is at firms and at brokerages, you sort of have what is your tolerance in margin calls, or what is your tolerance for margin? And the more out of the money your investors get, you start dialing down how much margin you'll allow them to hold. And so that's how you get that sort of accelerating thing where as it starts to go down and you start margin calling people, your firm's internal margin coverage needs to go up because the assets are riskier. So you give people less margin, so you margin call more people and sort of drive the whole thing into the ground. One of the things that I think we're going to see out of this really quickly is also particularly related to ETFs. Most ETFs now are very automated traders. They're doing something like, say, following an index because that's the lowest cost way to manage money is just say, well, okay, everyone who's in the S&P 500. And I think one of the things we're going to see with this is, your ETF isn't actually the S&P 500. It's all these individual stocks as interpreted by a robot to perform the same way the S&P 500 does.
Right. It's a representative set. So you get this representative set that moves in the same direction, but it's not a one-to-one.
Right. And the faster things move, generally the further apart those two things get.
Yeah. When but first-hand experience, I did a lot of my stuff during the Trump-China round one fights with tariffs. And a lot of that was just jumping in and out of ETFs, and depending on which ETF you selected, how they did their mixes, that was a significant part of me choosing which ones to play with, because some of them would, they wouldn't go up as much, but they would come down farther, that kind of thing.
Right. Also, ETFs, they have to decide how often they want to rebalance the ETF against what investors are doing with the fund itself. So if we say you have 1,000 shares of an ETF, and for reasons you decide to sell them, the ETF does not then immediately sell thousands of fractional shares of all their underlying assets. They just pay you out of cash that the ETF holds that comes out of the management fee the ETF takes. And then generally they rebalance it. And in environments like this, that can hurt really bad.
I think we sort of talked about this another time, was that there are certain mechanisms in the market where if you push them too far, things start to creak and crack. And not really one-to-one with this, but we talked about the inverse VIX failure, where just the fundamental structure of the thing broke at a certain point because it was going too much in one direction that caused much
so far outside. Right. Well, and when you go really far in one direction or another, when you're developing an ETF that's, say, going to follow the S&P 500 or something like that, you look at correlations. And so one of the things we talked about earlier in that chart I posted is how this event is breaking traditional correlation rules. And that's an incredibly dangerous place for an ETF to be, because if you're an ETF and you go, okay, well, gold has, say, a negative 90% correlation to the S&P 500, you may elect to use buying gold or shorting gold as part of how you're going to deliver your S&P 500 ETF. You don't have to just deal with the things in the index. You'll use all these other tools that are available to you, because you ideally don't want to go directly into the index stocks, because then you'll be the one moving the index and you're sort of trading with yourself. So you'll use things like gold or futures or, other types of assets that you can buy. And when those correlations break down, that means that like the underlying premise, like the investment thesis of the ETF is now false. This set of assets no longer correlates to the thing that it says on the box that it should correlate to. It correlates to something else.
Yeah, I mean, it breaks if you've ever watched investment television, CNBC, whatever your pick is, Bloomberg, the commercials will always throw in these ETFs, and they describe them as you're investing in all of this other stuff. But that's the premise that breaks at that point, is what are you actually, what's actually inside the box?
Underlying asset?
Yeah. Because you don't get to see inside the box.
I did want to note to the Sage that for Thinkorswim and a few other platforms, you can in fact make an inverse Kramer. There's a Think script that will do it. So not Kramer.
Mad Money.
Who by all accounts is a really nice guy, by the way, is apparently nice. And when people talk to him individually about finance stuff, he's very sharp, but trading against Kramer is...
He just likes to open his mouth a lot. So when you open your mouth all the time, you become famous for saying dumb things at dumb times.
Well, he does have to fill like 3 hours every day. Like him and, I don't know, conservative talk radio hosts. I did like, there was someone in markets and finance who came up with the idea of, okay, we could do is you have inverse Kramer and then you have long Pelosi, because those should be able to be balanced into a net neutral position on the market.
That's funny. Hey, that's something for another time, but I do want to check in on where we ended up with the whole, are we going to limit our politicians from investing in things? I know it's not. We have not.
It's
but,
not happening.
Yeah, is it dead in the water completely now? I guess so.
It is dead in the water for now. Some states are doing it at the state level now, where they're forcing new financial disclosure laws upon their politicians to specifically tell them what assets they are in ownership of.
And
I will say, so I've gotten into this too much here, but I'm very much like Chicago school efficient market sort of person, and that I believe the main way one earns returns is information asymmetry. That being said, to me, if you follow that sort of ideological line to its conclusion, then you end up with insider trading sort of is and isn't a thing. That being said, with politicians, you're talking about the people who actually make some of those decisions. And so you have, are we going to buy this jet from Boeing or Lockheed? It's always felt very gross that you could have some senator who's like, well, I have 1 million shares of Boeing, so let's do that one. Like that feels almost like Teapot Dome-esque.
Mm-hmm. Well, you get this. Yeah, and there's a whole like correlation thing that it's not directly aligned, but they're moving together.
So I have a regulatory question. So I know when you are an officer in a company, or you learn, privileged material information, you can't trade based on it. Can you trade if you learn about it from an elected official?
So, fun question. And I'm going to
I'm going to cite your advice when I get in trouble.
Please do not do that. Please do not do that. And for folks who were joining later on, I work in financial crimes for a major financial institution. One of the things that I cover, and very, very limited among my team, is securities fraud, including things like insider trading. And so this is a fantastic question, especially like the intersection of politicians and insider trading. That when we're talking about insider information and what insider trading is that this information, so it has to be material information. So something that is could reasonably affect a investor's decision making, and it has to be non-public. So, of course, as the word says, not known by the public. But it has to be in breach of a duty of trust or confidence. And I'm quoting the regulation directly here, on basis that it's in breach of a duty of trust or confidence that is owed directly, indirectly, or derivatively to the issuer of that security, or the shareholders of that issuer, or to any other person who is the source of the material non-public information. And I think that you would be so there's the classic theory of insider trading and like a misappropriation theory of insider trading. Classic theory is going to be pretty limited to like employees and associates of a company, of issuer, and so that's going to be that duty of trust or confidence is owed to the issuer.
My fund thesis of flying drones outside their windows is acceptable.
So of flying drones outside the company's windows?
Yes.
I mean, theoretically, that could be.
I'm actually aware of that when it happened.
Yeah. I mean, I would say that you probably couldn't prosecute somebody successfully for insider trading based off of that. But where we get to like the misappropriation theory with the regulatory definition is that any other person who is the source of the material non-public information. And I don't think the SEC or DOJ would ever feel strongly enough that would include learning the info from a politician or something. That's really directed towards being tipped off by the employer or by an employee or something like that. That would be in.
So what you're telling me is
of that duty.
Congressional intern / hedge fund manager is the most lucrative job in the world.
In theory, sure. I mean, because the thing is that you ask, what is this duty of trust or confidence? Because that duty of trust or confidence to any other person who's the source of the MNPI, really that person needs to have some duty of trust or confidence to the issuer. Now, where it gets a little bit fuzzy-ish with how this regulation is worded, but versus in practice, that if
we should really do a whole one of these talks on this subject, because it's fascinating to me as a thing.
So if you work for a company and you receive insider information and then you go trade in one of your competitors, that's still insider trading. If you tell your friend or whoever, they would then be insider trading as well. And so basically your duty of trust or confidence extends by proxy to this other person, and that's why but a politician
I would be
has no duty of trust or confidence to the issuer of the security. I mean, you could argue they have an ethical obligation to the public, but from a legal perspective, there is I can think of no legal reason that a congressman or any other politician could not trade based off of what they know as a congressman or as a politician. It's unethical. Obviously, that's why there's discussions of reforming this. But it is,
and I would be.
So if you learn from a politician information, then that is off you go. You're fine. You can do that. Now likewise, if you're on the subway or Amtrak or wherever and you hear somebody else talking, and again, don't quote me on this, because I will not testify in anybody's defense here. But my understanding, what I have been told and what I have read from case law and stuff, is that if you overhear that in public, you don't have any connection to that person. They're not telling this to you. You just simply overhear it at a restaurant, on a train, on a plane, wherever.
They have made it public.
They have made it public. You have no duty of trust or confidence to that person. You have no duty of trust or confidence to the issuer of the security. You couldn't be prosecuted. Now you might be investigated.
It does lead to something that I think this is also that one of the things we haven't really seen is, there are multiple accounts on Twitter and things like that follow how politicians invest. And it is interesting to me that you don't really see any of them taking, call it, material positions that relates to tariffs. You've seen them kind of short companies that are obviously exposed, but normally something that would be a workable sort of source of guidance on what to do just isn't there.
I'll jump in on that one real quick. With that statement, you are assuming that the tariffs were communicated appropriately to the people many of those accounts watch, which are usually in the legislative branch. However, we've seen with this and with some other things over the past really 70 days now that they consultations with the legislative branch tend to be an afterthought or upon being called forward. So I wouldn't necessarily think, I wouldn't assume they were given a heads up as to how the severity of the tariffs.
Right. I don't think
it was similar to it was going to go this far.
I don't even think there were people in the White House that seemed like they didn't even know that was going to be the way it was. So,
and since there's not a clear cut, because you don't have like a clear cut way that you would trade something like tariffs or these kinds of tariffs, like we talked about earlier. that also means there's nowhere to, even if you did know ahead of time, it's okay, well, what trade do you want to place?
I mean, it would basically be, I was going to mention this earlier, but when you're
Sell all
going to
your
cash,
shit.
being the first one to go to cash, that's the winning play. And then being the first one to go back into the assets that are advantageous, because
And
that kind of margin would be the thing that you would get. But I would also like to mention, because we've been talking about law and finance, none of us are giving anyone advice here.
Yeah.
And I just want to clarify that.
You know, you said that after the fact. I plan on citing every word of this conversation in my criminal defense. And now it's silent.
I will point out that there were a couple of politicians that, looking at their trade history, would indicate they've gone cash rich recently over the past couple of months. And I'll leave y'all to go through, since this is an OSINT server, to go figure out who those people were.
And one of the other things that I would say about like politicians and trading and stuff is that, yeah, we see on Twitter, we see on Reddit, we see other places, you know, this politician's trading this politician's trading that. You know, how does this correlate to their ongoing legislation, or does this happen ahead of some sort of major news announcement? Was this related to something that they know? And while it may be possible, yeah, that some of them are trading on things like that I think by and large that they're also, you know, a lot of them are rather boring in how they trade. Or also when they make some of these trades ahead of some sort of news in the world that, it's not something that should terribly be surprising. That a lot of reasonable investors could make similar decisions. And especially if you have an advisor who is paying attention to the news and making general guesses.
Will make the same kinds of decisions.
That a lot of these things, it might seem odd because they're high profile. But it doesn't.
But they're reasonable positions.
Yeah, it doesn't necessarily indicate any sort of nefarious intent, because it can be a perfectly reasonable investment decision.
Well, I mean, and going back to the economic theory thing, that it's the current price is a reasonable price. So someone buying at it is being fairly reasonable, and someone who sells at that is fairly reasonable. So, one of the things that's come up a lot on the server with just sort of like what people do is, people have retirement accounts and things like that, where they're trying to figure out like, okay, this big thing is happening and the market's moving a whole lot, and like, what's next? And I think one of the things that's particularly frustrating in all of this is that, normally when you're working as an analyst, you're doing risk management, fund management, that sort of thing, you have some idea of what you would do in different hypothetical like scenarios. You'll have different theses that you'll use based on what the market's doing and those kinds of things. And this sort of goes back to that thing where, because none of the education around that industry even contemplated this as an option, you have this sort of paralysis, both, in the space of like public analysts. I mean, even, people talked about Kramer earlier, and, he said everything from, prices are lower, it's a great opportunity to buy, to like everyone's screwed on Monday in like within 5 minutes.
Yeah, I do want to talk about that in a second. I don't know if you want to wrap this part up, but
yeah, sure, we can do that.
The big question of the day: how bad will tomorrow be? And I feel like I feel pretty safe saying that if nothing changes. Yeah.
If you believe in completely efficient markets, we can answer that question right now.
Okay.
Let's take a look.
Yeah. Because I'm getting the feeling from what I've seen, from the way he's playing it as far as Trump and the tariffs, the way Navarro is talking, and the way the markets are acting, I could see us hitting a breaker tomorrow if nothing changes overnight, because of the whole EU taking a stand on things ahead of futures. Now, the question is, will it crash that far before, like, will it be futures mostly? And will we see it in a couple of hours? That's another thing I'm wondering, because they're already talking about desks.
So I pulled up futures options, which are currently trading.
Oh, yeah, you're right. Mm-hmm.
And so this is very helpful. There is a 95% chance that the price will not go below 4,700 and won't be above 5,500. That's not real helpful, options traders. So it probably won't go up or down by 700 immediately.
Right. So we're talking about, well, it also depends on what kind of emotional response we get out of the market when the futures open, not just the options, but then when the actual futures open, do we see like other moves happen? And futures can be very strange over weekends. They can. We had a couple of times.
This is actually, I think, the widest I have ever seen the S&P 500 volatility spread, because it's 4,500 to 5,500 is the big bracket, and that's at 70%.
That's because you're talking about a bet on a bet on a bet. So
that's all markets are.
Right. You're how far removed are you from reality? While you're placing paper down.
As someone who lives in Las Vegas, I can tell you people can get really far from reality.
Yeah. Oh, the Vegas markets. The betting markets. Now we're getting that online, so that's great.
Getting there. We've been there for a couple of years. Online is probably more than in person these days.
Oh yeah.
Who has Polymarket open for tomorrow? What are they saying?
So Macau totally destroys online because it's a way longer money if you're a Chinese or North Korean official.
There was a question somebody had in chat. I'm trying to dig it up. Since we've already kind of gone, are we screwed? We don't know yet, but the market doesn't know either. Nobody knows. I will say that I have doomed like this on a weekend, and the open was like negative 107 and went up that day. But this is a weird time.
So my big financial transaction over the weekend was somewhere that sells ammunition was offering 0% financing. So I just maxed that out, and then I'll just sell it if nothing happens.
Yeah. So it was the Sage's question, by the way. This, what are we talking about when we see the? The two questions the Sage had kind of feed into each other to me. If the tariffs stay and we end up with a lot of unemployment, and then that shakes a lot of people out of, like, I'm using kind of disconnected language here because it is kind of a terrible thing, but if people end up losing their houses because of all of the market turmoil, that's going to affect real estate. Now, does anyone want to go in and institutionally scoop that up, or do we have buyers that are ready to buy into that, especially with Trump trying to get rates cut? There's a lot of things that could happen there, and commercial real estate is already weird, or at least.
And I'll note to Zach's point. No, you live in the NFT.
I don't think I could fit.
So real estate's gonna be an interesting one though, because it is a slightly more stable asset class.
So on a institutional level, real estate is essentially an interest rate trade. It's considered one of the riskier sort of interest rate swap investments. The problem that you run into is the circumstances where real estate prices are attractive as an institutional investor are not circumstances where you want to be an investor in real estate. If everyone loses their jobs or things like that, that means they're also doing things like not paying rent. And if you are, paying out an 8% note to pick up all this real estate, you really can't afford to let people not pay rent. So what tends to happen is on the risk side of things, companies have to reduce their exposure to that in volatility, or markets are going down, or people are trying to sell their houses. Institutional investors really can't then pile into real estate because there's too much risk in it at that point. And so their back office people come back and just go, no.
I will also say on the institutional investor side of going into real estate, especially looking at companies like BlackRock and some of the larger ones, there is a bipartisan desire to slap them out of that after some of the anger that came from COVID and the belief that they were the ones pushing up the prices. And I don't know if they'd be willing to tempt during all of this, pick up more of that.
The big thing I've noticed more generally talking to people in finance is the current sort of big goal is don't draw attention to yourself.
Yes.
Like just do your thing quietly and don't have people notice you, because if you get noticed by buying a neighborhood does, and if you get noticed by the administration in a good way, they're going to talk you up, and that's going to screw you over with half your investors. And if you're noticed by them in a bad way, that's also going to screw you up with half your investors.
So I'm waiting to see if they start purchasing manufacturing heavy industry sites, because it's mostly been biotech commercial real estate that I've been noticing over the past couple of years.
Is someone who works in oil and gas, if people would like to purchase former oil and gas processing facilities, they are welcome to do so.
That is funny. That's funny.
I wasn't looking to get a EPA Superfund site, but you know what? It's convincing.
It's not a Superfund site until you test it.
Don't look under the rock, and there's nothing under the rock.
Yeah.
Well, and so looking at like institutional versus retail investors, and retail investors broadly, regardless of wealth status, I would say that as like an institutional investor, you need to make returns to your own investors, and like you're not going to be incentivized to buy up real estate if people can't afford to pay rent. And you're not just going to buy real estate to store value in it with the hopes of it eventually going up and reselling it and all that. I mean, you could do that, but
well, you want your 2% under management and your 20% of upside. And if you're not going to make the upside, fuck it, do something else.
Yeah, but versus like retail investors, and I guess this gets more towards like middle class investors. There's always been this idea, as flawed in some ways as it may be, that it's like, oh well, you'll buy a house and it'll appreciate over time, and it'll be a good investment for you, and if you live in it for the life of your mortgage and sell it eventually, you'll come out ahead. And it's like, cool, that's great, that's fine, but like again, if you're in a bad economic spot, like people are losing homes or losing jobs and the impacts that has, then that's going to, it's like, who's going to go out and buy a house for the sake of buying a house themselves? And again, like institutional investors not just going to go buy up homes and sit on them in hopes that, well, the economy will eventually recover and people will want to buy homes then. So I'll just spend my capital and sit on it and sit on these homes.
Right. Well, your thesis always, on the institutional side, your thesis always includes a timeline. And these are the kinds of circumstances where you couldn't write that part of it. So when they're looking at it on the risk side, that timeline is a big part of how we look at that. If someone can't answer that, there's like, well, then your risk is unlimited because it could be 100 years. I mean, one thing I think that's underappreciated with something like, say, rent real estate is that when it becomes volatile for some reason, it becomes incredibly volatile. The example I use is and someone's going to OSINT this into finding my old address, but the condo I used to live in Las Vegas originally sold for $1.1 million. Then 3 years later, it sold for $60,000, and then it sold for $200,000. And then long after I moved out of it, it sold for $500,000 and then $100,000. So it's not, when real estate gets distressed, it moves a ton more than almost any other asset class.
Is that a Vegas thing? Because I've never seen real estate move like that here in Virginia, outside of something that has clearly been damaged.
That tends to be. Sorry, say again.
Oh, sorry. I was looking at the thread. I think I missed something. Go ahead.
So Las Vegas tends to be more volatile than most because how much the economy here is driven by people's discretionary spending. You see real estate in places like Las Vegas and South Florida and Southern California are the ones that tend to move that way, where when it's in demand, it's super in demand, and when it's not, it's not.
Interesting.
Someone brought up a good point. It's the Sage again, but the thing I posted was a graph of occupied units, vacant units, renting units. And you can see we're really suffering in the housing supply side of things. Supply costs and tariffs are not going to help that. I just saw a headline that did say that Trump's trying to open up things for lumber production, but that's not all you need to build a house. So,
right. Well, also, you have the tariffs, which impact the things you make a house out of. Then you have the people who are going to build the house, who are now, sewing stuffed rabbit heads on stuffed rabbit bodies. I actually agree with Tony, by the way, that to me it's insane that we view where people will live as a thing they invest on. That's
agreed.
always just baffling to me because
But
you're normally so like. I'm going to go through this really fast because it's not really what we're talking about, but it's always fascinated me. Normally, when you invest, you try to come up with diverse investments that don't correlate real well to each other. When you purchase a house where you work, you make yourself incredibly exposed to your local economy. So, for example, if you buy your house here in Las Vegas, when gaming's doing well, your employer's paying you way more, your house is worth way more, everything's great. When gaming sucks, you just lost your job, you're totally underwater on your mortgage, and you and all your friends are totally broke. So it is baffling to me that that's viewed as an investment.
That's why I have a bunch of farmland.
Can you grow red beans on that farmland, Moto?
Yeah, I should have seen that coming.
Red beans and chickpeas.
I still owe red bean hummus. For people that aren't tracking, a long time ago, I thought red bean hummus would be a good idea, and I just haven't had time to get to an Asian grocery in about a year and a half to make said red bean and hummus recipe that I cooked up in my head. So if anyone wants to make it for me and let me know how it is, much appreciated.
No, you don't get to get out of it that way. Let's see. It's interesting to me, Claire, on the chart you posted, how you see people, leaning further into renting and things like that. And so like using the house I live in now as an example, because I know it, my rent is way below what it would cost me to buy this house. So my rent is, my rent's about $2,000 a month. And then if I were to buy this house and get, a normal mortgage on it, my payment would be something like $3,500 a month. So we are in a really weird spot for particularly small scale landlords, just because interest rates have done what they've done.
Well, sorry, I had my dog start barking. But what's interesting is we do still have a correlation. Like we were in a bad spot after 2008, where renters were just skyrocketing past where the owners were. We're kind of bringing that back into parallel. But that vacant number, I was looking at it, and it's at like 2000 and what year is that? 2003 levels, and that
vacancy number
is, if you look at
Vacant housing units.
Yeah, vacant housing numbers. So it's housing inventory estimate of vacant housing units in the United States. So it goes all the way back to 2001 when they started tracking it, and you can see it, goes up, and it halts at its peak, which was 2008. And then it, we start burning it off and kind of stabilizing things, but it never comes back. So we end up back where we were in 2001, or 2003, which might be fine, but it should go up with population relative to where it was before the
Right, it
spike.
should be the same ratios and all that. So one question someone brought up is how the tariffs work with the transportation industry in particular. I don't think so. The industry I'm the most familiar with is energy, which is oil and gas exploration, basically. But they all sort of turn into the same thing with moving products from where people, where you make them to where people want them. One of the things that in the tariff package, if you look at it, there are some products that are exempted from tariffs. One of those is oil and gas. And the reason for that is producing a ton of oil in West Texas does not get you gasoline in Vermont. And so a lot of the existing supply chains now that are balanced by essentially by international trade, because you're making something somewhere else. If you make something on the West Coast, it may be cheaper for someone on the East Coast to buy it from Europe. When you do the tariffs, you lose that. And so now you have this whole set of products that instead of going by ships, which are far and away the most efficient way to move things, you're moving them by trucks and trains and those kinds of things. And so I would expect over the near to intermediate term, you're going to see a lot of demand on transportation to sort of patch over these planning, these sort of logistical hiccups that companies will run into. For the U.S. making enough oil, the U.S. is a net oil exporter. So if you took all the oil the U.S. consumes and all the oil it produces, there's a surplus. The problem is it's not really in all the places that we want to use oil. So there's a huge surplus in places like West Texas and North Dakota, while there's a big deficit in places like the Northeast. And so that's generally handled by U.S. crude oil is shipped out from the Gulf of Mexico to Europe or Asia, and then in the Northeast they import it.
Do you think that's one of those things actually that would solve itself? The Jones Act got relaxed.
Realistically, what would solve it is pipe. That's far and away the most economic way to do it. If the Jones Act was relaxed, shipping to Western Europe versus shipping it to the West Coast by ship, they're pretty close together. So what you would probably see is West Coast pricing would be more in line with crude oil pricing in Europe. And for Iran, there are some particular sectors that are excluded. Like I said, energy is one of them. I'm not familiar with the others. I didn't go through that set of list. I just was told it's excluded.
I have not had time to look at the full list yet either. So that's been one of the more interesting things. I'm glad to hear the energy was excluded. But I wonder if batteries have been excluded. And that's one of the things I need to figure out. Because I don't know if y'all realize this, but most of our batteries are not made in the U.S. unless they are lead acid batteries.
That's why one of the drones I have can fly on lead acid.
And if anyone tells you lithium batteries are made in the U.S., go laugh at them, please.
I will say one of the things about the whole tariff thing that introduces some maybe uncertainty on one hand, possible hope on another is, and this goes back into like the regulatory side of the world, is that the tariffs, the so-called reciprocal tariffs, are promulgated under IEEPA, the International Emergency Economic Powers Act, which is usually what we use to sanction other countries. There hasn't really been, there hasn't been any use of IEEPA for tariffs, and especially not this wild. The closest thing is that in 1971, Nixon brought out a 10% tariff on all imports, and that was under the Trading with the Enemy Act, TWIA, which was later reformed into IEEPA. But there's a lot of legal debate over whether IEEPA gives the president the authority to issue tariffs. Lawfare,
and the House has had to do some. The House has had to do some sort of legislative gymnastics to make it work, hasn't they?
Yeah, because the national emergency part of it, because the actual executive order talks about IEEPA. IEEPA is the first thing that it mentions for authority. National Emergencies Act is the second, and then there's a couple of like tariff specific things, but they don't necessarily give the president. Those sections don't necessarily give president the authority to add on new tariffs. It's just more or less how some of that gets worked into HTS. I believe IEEPA is the big thing, but the National Emergency Act basically says that Congress has to review this within a certain amount of time after the emergency is declared. I want to say it's 15 calendar days.
That was, I think the House had their thing where they just declared that, well, it's one day.
The rest of the year. Yeah, the rest of the year is one calendar day. So Congress isn't necessarily going to review this because the Speaker doesn't want to put it on the yeas and nays of who's going to, who in the GOP is going to support the tariff.
In a sense, by doing that, they have reviewed it.
Well, in a sense, I guess, although it really sidesteps, and it's been used to sidestep national emergency declarations before. The Democrats did it back in like 2020 or 2021. A couple Republican congressmen wanted to vote to end the COVID emergency, and to sidestep that, the Democrats did this similar workaround that it's like we're declaring the rest of the year to be a single calendar day. But I'm surprised we haven't seen as many challenges yet to the tariff declarations. I think that Canada and Mexico weren't really being challenged much because of some of the uncertainty there and that it was being delayed and all. We might see challenges soon to the reciprocal tariffs. Lawfare came out with a pretty decent article back at the end of January about like the case against IEEPA tariffs. And I personally find it pretty compelling. And the only issue is that there was a court decision in the 70s following Nixon's tariff declaration, because this was under TWIA, but there was a similar case. So there was a case at that time trying to challenge Nixon's 10% tariff, and the appeals court ruled in favor of the TWIA tariffs. The IEEPA language isn't that different, but nevertheless, I think it's an uphill battle to legally justify IEEPA tariffs. But that, again, introduces uncertainty, and I'm sure somebody will challenge the tariffs. Who knows what kind of actor they'll be. But for businesses,
that does go into tariffs. Do you want to be the business that says that?
Exactly. One, do you want to be the business that says that? Do you want that attention put on you? But also, as much of I see it being an uphill battle to defend IEEPA tariffs, from a business aspect, yeah, your tariffs are going to impact your bottom line. You don't like it. Is it better that you shut up and take it and learn how to deal with it? Or are you going to try and fight it and then have the possibility of it being struck down? Okay, cool, I don't have tariffs anymore. And then all of a sudden it goes to an appeals court, and the appeals court says, okay, tariffs are back on, or no, they're off. And then maybe it goes to the Supreme Court. And so this just gets drawn out over such a long time that you could have injunctions and restraining orders and all of this that are pausing tariffs and putting them back on, and you just you might not want to deal with that as a business, and you might just be willing to say, this sucks, but I'm going to deal with it.
There's a couple of things here that are going on that I just want to bring out. Constitutionally, the legislative branch has almost complete authority to create tariffs. They have delegated most of that to the executive branch. And so, better for worse, whether y'all might have some opinions on this, Speaker Johnson had the Congressional Budget Office, I think, or one of the other analysis groups within the House, do a report in early February. They published it late February, that explicitly outlines the current regime of tariffs that have been delegated to the executive branch. And it is broadly accepted that the executive branch in the current environment and the current legislative landscape can just go ahead and create whatever tariffs they want, and that will be fine.
Enough of it's sort of like the authorization for the use of military force.
Yeah, until the legislative branch wants to start clawing some of that back. And we saw that recently with the Senate. So the Senate said, no, we are going to start clawing some of this back. And enough Republicans jumped to join the Democrats to possibly put a stop to the tariffs on Canada. And now they're going to have to take that up for vote, I think, in the next couple of days, if that hasn't already happened. But
I think the other question there is,
the legislative branch could act against this if the desire to do so.
Pressured to do so.
Yeah.
One of the
other
problems I see, though,
Apogee, just really quick, from a business perspective, no individual business would be suicidal enough to take this on. You would likely see it come through an industry group.
Well, and one of the things that I think a lot of this also leads into is, if the idea of limiting trade in this way through tariffs doesn't work legally, my expectation would be that the administration simply uses other methods to get to the same place. There are a lot of ways to be protectionist. And
there are, but there won't be many other ways they can use to generate revenue the way they want to.
Right. Well, and they lose that sort of budget item that allows other things to happen. See, we've been going for a while. I'm happy to keep talking if you guys want to, but we can also wrap it up.
I said earlier I could go for days. We can make Cory Booker look like an amateur.
We'll just run Florida out of hard drive space. That's the plan.
Yeah. Look, I mean, as long as people have questions or something like happy.
Yeah, I mean,
about it.
Yeah, it is interesting. Sage mentioned that it's nice to know that, okay, like, people who know about some of the finance stuff are also just utterly baffled by it. And that's, everyone is confused. So for the housing market to crash, the housing market now is nowhere near as leveraged as it was in 2008. And a lot more of that debt is backed by the federal government. And so that means if you are a mortgage lender on the risk side of things that made you close everyone out in 2008, now you're able to just say, okay, well, the feds are going to bail this out because they've legislatively said they will, so I can just foreclose. So you don't have the same risk environment you had then for those companies.
And
they can't be compelled to liquidate. You can carry your mortgages at 1-to-1 on your balance sheet, no matter what the value of the house does, because the U.S. government is backing that mortgage.
And one thing to say about like mortgage delinquency rates, because there was something that went viral a few days ago, I feel like, that was talking about mortgage delinquency rates being up. And there was some graph that was used, but it was kind of like misconstruing the graph as representing delinquency rates. This is from the Fred. It's accurate as of February. That's when they last updated it. And there was there was a increase in Q4 of last year. But it's not a not a terrible like increase or anything.
And the thing,
just relatively
I know looking at that graph too is that with the exception of 2008, other recessionary environments didn't. I mean, you can find, you can see the 2001 crash in there, you can see COVID, but they don't seem to have. Excuse me, they don't seem to have a huge impact on, delinquency. That seems like something that is generally going to be very sector specific. So for the next question about,
I was going to say, so like it's just generally hovering around like 2.5% or lower most of the time, with the exception of like 2008 and then the recovery from that. I mean, and we do see that for a pretty lengthy time. I mean, it shoots up there in 2007, 2008, and eventually peaking around that looks like 11%-ish. 11.5% in Q1 of 2010. And so it stayed relatively high. Like we didn't get below 2.5% until Q4 2019.
And in that environment, you had all the mortgages where the mortgage was for so much more than the value of the house.
Yeah,
that there was sort of no reason to pay it. I knew people then who just basically their response to their bank was like, okay, fine, foreclose, eat 90% of this, or you can wait.
So even with COVID, like we're at like, if you look at just how things were trending, it's like we're kind of at where it should have been, like if COVID didn't happen. And so I don't think that, like, I'm not personally concerned about mortgage delinquencies right now, absent something,
and they're not
catastrophic.
Well, and they're not systematic the way they were.
Yeah.
All of that being federally insured means that if you're a bank or, an institutional investor, no matter what happens to mortgage delinquency, you can carry it basically at 100% on your balance sheet. For all intents and purposes, it's exempted from being marked to market in most cases. So on the question about sort of protective actions you can take, so one of the things we talked about early is how this crash so far is unique in that everything is down. So normally what people talk about when it's okay, I want a less risky portfolio or I want less risky investments is, you talk about things like treasury bills and gold and, stuff that tends to retain value even when economic conditions are bad. What's unique about this is those assets are also going down. And so I'll go ahead and send that again. So what we would look for if we were trying to mitigate this risk as a, institutional investor or hedge fund is similar to what you do if you're, an individual. But what we would look for would be, which things in this set of data aren't correlating with each other. And that would tell us, okay, here are different things that can hedge our risks. So here, we have the S&P 500, natural gas, oil, gold, and silver. Normally, silver sort of sits in the middle because it's used industrially. Gold tends to go up in distress because people view it as kind of a safe place to go to. Whereas natural gas and crude oil tend to be, indicators of economic activity. They're all kind of going with each other. And so that makes trying to come up with a good way to protect your assets really difficult. I know Ryan earlier posted the link to, I think it was the Treasury's inflation protected bonds. Those are probably some of the only things that are somewhat protective for this. So far, those aren't inflation protected assets haven't been outperforming non-inflation protected assets in this environment, which is a little weird. And it just kind of goes back to that everyone's kind of selling everything. The upside is you can't really do that indefinitely. You know, at some point that pile of cash has to go somewhere. And that's, you know, what we'll probably see on Monday is where that allocation is.
I do want to back up for a second. The Kiri, whatever, the fish with the fun glasses, profile pictures. I believe it wasn't delinquency rates on mortgages that were going up, but I do believe delinquency rates on revolving lines of credit are starting to tick up and have been for a while.
Right now, and those really, you know, that tends to be a combination of sort of broad economic activity and the interest rate environment. You know, one of the things that the Fed has said in the past is that, you know, they don't exist to bail out government policy. And so I think if we see, you know, massive inflation or something like that from this, we'll see them, you know, we're not going to see them hold interest rates down to try and preserve economic activity. I think what we'll see is them push rates up to try and control inflation.
Oh, that list looks like it's been ticking down recently, or at least through 2024 to now. Wonder what it's done the past couple of days.
You know, and again, I'll note that if you look at other crashes, 2001 and then 2012 to 2014, you don't see a strong correlation generally, because what happens is banks stop loaning people money. You know, so even though consumers have less cash and, you know, don't pay, banks make it harder and harder to get credit. And so that tends to help pull those delinquency rates down.
And I think, like, looking at even different types of lending, like, we're seeing so some of this is an uptick in delinquencies. I mean, yeah, like, you look at credit cards, you look at consumer loans, it looks to be up quite a bit, and in particularly a very short amount of time, and I think some of that's due to inflation. But I still have a hard time reading that all of a sudden means we're going to have some sort of, like, market crashes or anything along those lines.
Well, and these tend to be fairly railing indicators. You know, on the business side of things in particular, you know, your bonds going into default or being delinquent is kind of the end. You know, when you hit that, you know, that's when the company is insolvent and being liquidated. You know, so they do tend to also be pretty trailing indicators. You know, so I don't think things like delinquency would even reflect much of anything after Trump was elected. You know, that event wasn't predictable enough for someone to trade around it or to make decisions around it. So I think, you know, it's probably, if I had to guess, another 6 months to a year before we see really material changes in that, unless, you know, the tariffs just absolutely wreck things and people just go, oh, screw it, I'm not paying my credit card.
Yeah, and looking at, like, business, the delinquency rate for business loans and for commercial real estate loans, like, they're starting to tick upwards a little bit more again, but we're still talking, like, close to historical lows. That pre-COVID for commercial real estate was, it looks like, an all-time low. And actually, Q3 2022 was the all-time low for commercial real estate delinquency. Like, but almost right before that was Q4 2019. Right. And now we're starting to trend up a little bit more. We're at, like, 1.57% delinquency rates right now, but it's right, generally overall stable. Like,
which, you know, people a lot of times will talk about interest rates and, you know, what makes sense with that sort of thing. You know, if you go sort of like the efficient market version of this, the natural interest rate should be roughly whatever the delinquency rate is. And so it is, whenever you see that graph, it's always kind of interesting because that lines up pretty well if you view delinquency as a trailing indicator.
I guess that makes sense, yeah.
Because theoretically speaking, if 1% of borrowers default, you know, your bank needs to charge 1.1% on its loan to make money. And if it, you know, it goes above the cost of capital to do that, then some other bank will come in and loan the money a little bit and accept making a little bit less money. You know, so those tend to stay really close to each other. You know, but again, the current environment is one where a lot of these sort of things that are just taken as, like, fundamental economic truths haven't really been thought about or studied in the context of using things like tariffs this way. If we do this for too much longer, the futures market will open, and then we get to talk about that.
So I was going to say that we're starting to see markets open in the Middle East, and they're coming down fast. I think someone was just posted about Saudi Arabia has crashed about 7% so far today. They've been open for an hour or two, I think.
Now, there's a little interesting because Saudi Arabia, Dubai, markets like that tend to be very energy dependent for obvious reasons. And so, they tend to track very, very closely with what crude oil does. I think oil and gas may be one of the sectors that other countries realize they actually have a stick to hit the U.S. with, just because the U.S. is the largest exporter of petroleum products. So there's some of the movement there will also just be related to the price of oil and reduced economic activity too.
Also, I apologize for my earlier statement. Saudi Arabian market was open today. Sunday is a business day over there, and it is now closed. So it fell about 7% for the day.
Okay. Now, they wouldn't have been open Friday, so that would be their...
Correct. I made the classic, I forgot about business days in the Middle East mistake. I don't know, Ari. My egg prices still haven't come down too much, but I own my own chickens, so, I have set costs there.
Until, you have to pay for grain.
That was an acre of land for 6 chickens. They can eat well. Yes, it is true. These ears are worse than the Smoot Haliat sage by, I think, almost an order of magnitude.
And I will just note that egg prices in Las Vegas are still not bad, but they didn't get bad to begin with, so I'm not sure I'd noticed.
I didn't really notice them until I was out of eggs the other day and had to go to an organic market and pay $11 for a dozen organic eggs, but those are organic.
What a moment for the city you live in. That is classic.
I grew up in Northwest Arkansas, so I was used to eggs being like less than $1. I do question how many eggs people consume, though.
A dangerous thing to question on this server. We have a couple of individuals who are proud of their 30 to 40 eggs a day. Y'all have any other questions? I see a bunch of people typing. Are those questions or those...
we can talk about eggs, too. I'm good. I warned people that this would turn into the standard EMVC thing, so... I'm
down. The real question is chicken egg markets have been rising. What about, duck eggs or ostrich eggs? We've seen any movement in those markets? People have looked for alternative egg products.
Unfortunately, I cannot pull up a futures market on duck or ostrich eggs.
Really? I'd be surprised if there wasn't one over in the EU somewhere or Asia for those, at least for duck eggs.
So one of the things I do, and I know it's kind of running into the chat and in our conversation, is people, have a lot of conversations about the tariffs being good and bad. To me, when you look at it on the investor side, there's not really a value judgment associated with that. It's more they just are. They introduce a lot of volatility, and it's really obvious that markets don't know how to trade this. Those being good or bad depends on whether you're long or short. They're definitely very unorthodox as far as ways to try and manipulate the economy.
Has anyone else done tariffs like this in modern times? Not like
developed countries.
Has any Western country done tariffs over 10%?
The only thing I can think of that would be, you can come up with some. The problem is when that's happened, it hasn't been, the country wasn't developed at the time. This goes back to sort of that economic thought thing where there's kind of no one does this. You can look at Japan, like I said, in the early 70s. A couple of Latin American countries have done similar kinds of things. It quickly evolved into something else. In the case of Japan, it led to a big industrial expansion, which was then leveraged into a bunch of other things. In Latin American countries, it tended to just kind of blow up. You didn't see it over time because they couldn't sustain it. Now, the U.S. is kind of unique in that it's large enough and there's enough economic activity that you can run a bad decision for a lot longer. So there's not really one that occurs to me where you have a sort of developed service economy country decide that it wants to go back to being an industrialized country, because most people don't want to live next to factories.
I have a bit of a hot take here. I'm not actually sure that the tariffs are a bad thing. I think maybe the way they've been rolled out is going to be troublesome, but in a lot of ways, like if the policy intent is to reintroduce industrialization into the country, this might be one of the better ways to approach it.
Also, Apogee, I believe we can now just ban Moto.
Can I get a third?
So, to me, when you talk about them being good or bad, it's, it depends on what the effect that the administration wants to achieve is. I can't think of an effect they could want that would be best served by the way they're doing this. So to me, it's
if they're trying to bend people over a barrel and force them to the table to negotiate, this might work.
In those circumstances, for something like that, what I would expect them to do is pick specific countries, more like what we saw in the first Trump administration, or like what we saw with Canada and Mexico early on, where you go, okay, we are going to totally screw over your one country to force you into a good deal. When you do it with everyone like this, you put the people on the other side of that conversation in a much stronger position than they would otherwise be in.
I've always been a big fan of picking a reasonable amount of fights to fight all at once. Not fighting
if it's everyone, it's technically just one fight.
Maybe that's a hard battle to row.
I will note, Clear Signal, on basing our budget on tariffs, there is like a weird East India Company vibe to the whole thing. Like this whole conversation would totally fit in like early to mid 1800s, like sort of towards the end of European countries with colonialism and protectionism with each other and industrialization. Fit great then.
I mean, my issue with that, based on the budget on tariffs, is what you're doing is you're betting against your policy working at that point. Because what you're saying is, we're going to continue to import things because we can't possibly make these things here in the United States. So we're going to base our entire federal budget around these perpetual imports that are going to happen, which seems to be betting against their intent.
Well, and it's kind of like one of the examples I use is taxes on things like cigarettes going towards, say, state healthcare, where if you raise that tax high enough to where people stop, like quit smoking, then you have less money for healthcare, or the thing with using
favorites,
or things like, the gas tax and electric vehicles where, okay, if you make that too high, then you don't have any money to maintain roads with.
Okay. I can actually speak to both of those very authoritatively. So here we go. I will say I'm a huge fan of vice taxes funding public health, especially when it is tailored.
As someone from Las Vegas, go to hell.
Yep. Especially when it is tailored towards any sort of like funding the cessation campaigns for those objects. So if most of the cigarette tax is going to funding cigarette cessation, I'm totally fine with that because those should kind of correlate with one another.
They should correlate. Yeah, the amount of money you need to spend on getting people to quit should be roughly related to how many people you want to get quit.
And then with gas tax in particular, really unpopular opinion, so we'll see how chat likes it. But we've kind of moved beyond. Gas tax made sense in an age where it was cheaper.
Everything used gas.
Technology. Well, you could do it at the pump. You didn't have to do it on the individual vehicle. But everything these days is so connected and so networked, it wouldn't be unreasonable to expect a road use tax to be plausible these days.
So you're telling me that my 2003 Honda Accord needs to live forever?
I'm telling you that when it goes in for the yearly inspection, which you would need to implement in a state with a road use tax, they could record the odometer and send you the bill.
I move states every year. Got it.
Okay. But electric vehicles in the increase in fuel efficiency is putting a strain on transportation budgets as it's no longer covering what's needed to maintain the infrastructure.
Well, I mean, there are a lot of things where when you have that disconnect, you ideally want your sort of taxing mechanism to be connected to how much you expect to spend on something.
Yes, I'm a huge proponent of making sure your budget and your revenue is in line with your policy goals and ensuring that they're not working against one another.
Well, I mean, I think that's, going back to the tariffs, that's one of the big disconnects is there's not, Trump doesn't have like a really strong ideology. He's not someone where you can say, oh, okay, this is like the intellectual school of thought that's being followed here, and you can use that to kind of work around it. It's really how each of these things seem to strike him on an individual basis.
And ultimately, he has to go back to Congress and get them to grant him the authority to generate revenue in this way. So what he's done is he's jumped the gun and said, this is the way we're going to do it. But Congress hasn't allocated what happens with those funds or how they're used yet.
Well, and you don't really have, one of the things we've seen with a lot of things with Trump is that if Congress elects to not do anything, it's a lot different. There's a vast amount of authority in inaction. And I think that's one of the things we're seeing with the tariffs is, Congress, if it felt politically inclined to do so, could come out tomorrow and say, yeah, no, we're not going to do that. And it just wouldn't happen at that point. But as long as Congress doesn't feel inclined to intervene that way, the president has a vast amount of authority to do all kinds of different things like this.
Yes. But he does not have the authority to spend all the revenue that's going to come in from tariffs.
I wonder, and I don't know it at all, but I do actually wonder what happens if, Congress does nothing. And so now you have this revenue coming in from these tariffs. Where does it go?
I don't know how that works on the federal level. In a lot of states, it might go into a rainy day fund of some sort until they decide what to do with it, or it could just be
figure it out.
Another account. Yes. But if the federal government does have a rainy day fund, it's useless given our debt.
So yeah, you do run into things where by Congress not acting, you do end up with a lot of things where you can't, Trump can do things like institute the tariffs, but can't then spend the money in a way that might mitigate some of the negative effects of the tariffs. And so, that's the other risk here is that you do this and, say the tariffs are upheld, but there's not enough of a majority in Congress to actually use it on anything in particular. You can end up with what would normally mitigate some of the harm would either be, the reduction in income taxes or increased federal spending where they use the money for something. Those things don't really happen until Congress decides to get involved. And once they decide to get involved, then they have to be kind of on the record about what they think about this.
Yeah,
and so I think that's something that'll be interesting to see how that plays out over the next couple of months. Because theoretically you could bump enough federal spending to mitigate most of the, individual economic harm that the tariffs would cause.
With all the messaging around reducing spending and reducing government waste, there's zero appetite to increase federal spending, to create new departments. I think the only path forward here in a sticky situation is going to be to take it out of income tax.
Right. Well, and that from a economic mitigation perspective, that's in some ways the same thing where, now taking it out of income tax will benefit people who pay income tax or a lot of income tax more than people who don't, so you do end up in a circumstance where, someone goes to Walmart and they buy a t-shirt for $5 and now their t-shirt's $7 and those $2 in tariffs go into the federal government and that reduces income tax. So then, that $2 is in effect being redistributed to the people who used to pay that income tax, and that's ideologically something I could see, Trump being okay with.
So Tony, you point out a good point. In Project 2025, there is a mention of a sovereign wealth fund. I think if the tariffs were used to kickstart a sovereign wealth fund, and that sovereign wealth fund was used with the express intent of re-onshoring our manufacturing capability, that could be a position where the policy will work with the budget pretty nicely. But
to me,
I haven't actually seen any movement on that. Maybe they are, but I feel like I would have seen or heard some rumbling at this point if someone was planning on doing that.
Also, I think you run into the problem of just the scale of the tariffs and the amount of money that you're talking about. There aren't sovereign wealth funds that work at the scale of the United States. That trying to place however many $1 trillion is incredibly labor intensive to do. And that kind of goes back to what we talked about earlier, where, a sovereign wealth fund works similarly to an institutional investor. And it's the same problem with something like, say, privatizing Social Security, where you have this huge pile of money that outweighs every other participant in the market.
Yeah. And it would outweigh pretty much every other participant. But yeah, they might go to use it on things. Yeah. I would need to read more into that. Oh, look, there is an executive order on sovereign wealth fund. Thank you very much, Arya. Came out in February, and they have to deliver a plan within 90 days. So when did this come out? February 3rd?
Yeah, but we've declared that one day is the whole year, so it's fine.
That works on the legislative calendar. not necessarily an executive branch calendar that is actually guided by true days.
Days from here forward will have 2 sunrises and 2 sunsets. They'll be the greatest days, the
So
biggest
this
days.
plan is owed to us in about 30 days, really 23 days, 27 days. So we should be hearing something about it here shortly. Cool. I'm a big fan of sovereign wealth funds personally. So that'll be interesting to see how that plays out.
And I mean, and to be fair, several states already have sovereign wealth funds.
Which state has a sovereign wealth fund? Virginia does.
Alaska.
Texas has 2, actually.
Interesting. And it's separate from the pension fund, state pension fund.
It is. So Texas has the permanent school fund and the permanent university fund. So the permanent school fund, it funds public schools, so primary and secondary education. It also, trying to think of it, if it funds any state universities.
It does.
But the permanent
those-
university fund funds the UT system and the Texas A&M system.
Those
Doesn't fund any other state universities.
So some of those in the school fund, you also get things like community colleges and things like that. So in Texas, those 2 funds primarily exist to deal with oil and gas revenue off of state lands. So when you drill an oil and gas well, you lease the land and you pay, generally between about 5 and 25% of the revenue from the oil goes to the landowner. If the landowner is the state, then generally a state that has a large quantity of that, like Texas or Alaska, has those structures for that kind of thing. In Alaska, you have the state itself, mental health trust, SERI, organizations like that. In Texas, it's mostly the schools. There's also Scottish Rite Hospital, which does a bunch of community medical care stuff, but it tends to be resource extraction states that do that.
Interesting.
I think most state sovereign wealth funds are like oil and gas based, I want to say, or at least some sort of natural resource.
Yeah, they tend to be tied to those also because those revenues can be vastly larger than what your state might spend that year. So you need some structure to deal with, okay, we got $100 billion and we're going to spend $10 billion. What do we do with the last 90?
So Imperial, is that the name? Yeah, or something like that. That is an interesting way to put it. I could definitely see the federal government possibly using something like a sovereign wealth fund to bully industry. That really comes down to a question of how you would go about doing independence of something like that. We've all seen how independent institutions have gone so far, but the Fed has maintained a lot of its independence.
You need a committee.
That's a good thing to think on. I would hope the legislative branch in establishing a sovereign wealth fund makes it independent, like actually independent, like the Fed. That would be preferable, if not handing it to the Fed.
No, president has to individually sign each one.
That would be.
And my headphones are now beeping, telling me that they're about to die.
Yeah. Mine have been doing that for a while too. They'll probably go through shortly. Well, it was fun.
It was. We should definitely do more of these. If you have any other questions, I'm usually sitting around in some room on here or ask them in markets and finance, and we'll catch them, and then we'll see if we can organize something else like this again in the relatively near future.
Also, Apogee, before we all go, what is the intent for this new markets and finance role?
That is very open-ended. We will see. So I created it for us to have fun with it, and as something happens, we'll see what's up. Whether it's more of a news desk type role like we've used with some, or if it's like a channel role like with the space notifications or severe weather, stuff like that. But we
I say we just ping it at random.
Yeah.
Everything has some financial impact.
There you go.
I can justify pinging that role with every message.
I could take a picture every morning of a gas station, gas prices at some station, and ping everybody with it, and see what happens.
I'll take a picture of the strip because it shows discretionary spending.
There you go.
All right. It's been fun. I'll talk to you guys later and hopefully get to do another one of these. And it was fun to get everyone's kind of feedback as we went instead of our usual mild echo chamber thing in EM voice chats.
Yeah. Thanks everybody for joining.
Have a good one. Bye.